Welcome to This Week in Money. I'm Jim Goddard. Today, Martin Armstrong of Armstrong Economics believes quantitative easing will lead to a major market crash. Cyclesman Tim Wood explains the longer and higher the equities markets climb, the bigger the crash will be when the next downturn cycle occurs. We'll talk to Martin Armstrong right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Martin Armstrong, founder of Armstrong Economics. We're speaking to him from Switzerland. I hope you've kept up on your yodeling lessons.
I think they gave that up a few decades ago, but go ahead.
Yeah. Anyway, Martin, some very interesting things to talk about today, and I think one of them that we can't forget about is how close the U.S. government came to be totally paralyzed thanks to its fiscal ignorance or malfeasance, whatever you want to call it. And we know it's just going to be repeated again in just a few months when, again, they hit another debt ceiling and they owe more bills. Any solution to this thing, Martin?
Not really. I mean, I think the Democrats are trying to use it as the lever to pry the House away from the Republicans. The Republicans are really kind of dividing, and you have more of the conservative Tea Party group that wanted to keep the House, the whole government shut down. I mean, I understand what they're doing. I think their motives are perhaps good, but the methodology of just shutting the government down is just not going to really be much of a help for the global economy, and I don't think they really appreciate that. But I don't see any real longer-term solution. That we're probably looking at another debacle coming up in February and January, and it's just more and more of the same. And it's governments around the world. It's everybody just, for some reason, they just borrow year after year. There's no intention of paying anything back. And, I mean, a 2-year-old wouldn't come up with a system like this.
Right. Well, in Canada, our finance minister says we'll have a balanced budget in 2015. And he says he's already $7 billion ahead of what he thought he needed to get to that point. And he wishes he's not a big fan of quantitative easing. That wasn't the solution Canada used. They really did, cut government programs. They closed the busiest Coast Guard base in Canada, which was here in Vancouver, as part of those cost-saving plans. So at least one government is giving the appearance that it's doing it. But if Canada alone is looking after its finances, it would just be swallowed up in the economic backwash, wouldn't it?
Yeah, I mean, it's largely, a systemic problem that goes from Europe all the way over to Japan. I mean, and we really should not be borrowing money, period. We should just largely, as nuts as it sounds, but we should just be printing what we need to cover the cost of government and cap that at maybe 5% of GDP or something. Because all they're really doing is they're borrowing money. They never pay it back. Even if they balance the budget, that's very nice, but how long does that last? And you still have national debts there accumulating interest, and about 70% of the total national debt of the United States or Germany, you can look at them generally in even world almanacs. About 70% of the entire outstanding national debt is accumulative interest. So this whole theory that, we're going to tax the rich to benefit the poor, no, it doesn't. It just goes out to the bondholders, and in the case of the U.S., 40% of that is basically held by different governments. So the quantitative easing that the United States did, that's why I said it's not going to do anything, because the U.S. dollar is effectively the reserve currency. And when you're looking at a global contraction, in the United States alone, it was at least $7 billion, the trillion that came down in loss in asset values. So increasing it by $3 trillion doesn't do anything. It doesn't create the inflation that people were saying, oh, it has to be inflationary, and that's not true. That's, if you didn't have a contraction to begin with, then yes. But when you're offsetting $7 trillion in contraction, plus the entire world is contracting, and they're all using dollars, it doesn't create the inflationary boom that people expected.
Is there any alternative to using U.S. dollars right now?
Honestly, no. At this stage in the game, I think that we'll end up with some sort of a non-denominational world currency for reserve purposes. But Europe is a basket case. You can't use the euro. You can't use the yen. So what are you going to use for reserves? Are you going to use China or rubles? You can't divorce the problem from the domestic political objectives of a particular country. So that's why I say I think we're going to have some sort of world currency. It'll probably be electronic and not something that people use to go buy something with. It would be largely for exchange between countries. Because what happens largely is the United States, with the quantitative easing, then other countries, it exports whatever it's doing domestically. So I think that's the problem of any one country having its currency as a reserve. And so we have to come up with some sort of non-denominational.
The British would love it if you went back to the pound, the way it was before the Second World War.
Yeah, they all would love that. China, would like their RMB. Everybody would say, oh, we'll use mine. But, there's a serious downside to that, and that whatever the United States did, it could not do, honestly, from a perspective of pure independence.
And, of course, Americans love that. They reserve the right to bomb anybody they want.
Well, I think they honestly, 25 years ago, I would really sit down and talk with politicians, and there was an understanding. There was a light on. I knew Margaret Thatcher, et cetera. I could actually have a conversation about the economy. I cannot today. Ever since Bush Jr., effectively, they're all just show. That's it. When I go down to Washington, I talk to chiefs of staff, and when the politician enters the room, largely the conversation dumbs down to, okay, fine, we have to speak in simple terms. And it's really that bad. So I don't see where we're going to have much hope until we have to kind of crash and burn. And then we'll get the average person, off the couch, stop watching TV, and say, hey, okay, now this is serious. I'm losing something. So until that happens, there's not going to be any real change.
Right, and I don't see the average American really taking that much interest. During the latest fiscal crisis, the average person in the U.S. totally unaware of it because it didn't affect their day-to-day life.
Exactly, and we'll begin to see if some people are starting to get it. November 1st, they're going to be cutting back like food stamps and stuff like that. So we're going to start seeing some cuts in the social benefit programs. But the elderly they were told to, invest in housing and save, and that's how you'll survive for your retirement. And they brought interest rates down to virtually zero, so the elderly are not as well off as they thought they were.
Right, and I heard the alternative is if they did look after that particular section, is that it would cause a collapse someplace else.
Well, this is the problem. The whole pension fund system is collapsing. because they've kept interest rates so low, and the banks don't really pass it on. The spreads between what you collect at a bank for a 3-year deposit in the States, they're offering 0.5%. Yet you ask for a car loan for 3 years and they want 4%, and that's fully secured.
Right, and other people are paying 13.
Yeah, so it's just crazy. It's the spread between what they're paying people and what they are asking is just huge, and the banks have been using it to cover all their losses from it before.
And of course, it was the taxpayer who bailed out the banks. Some experts now say maybe we should have let them fail. Should they have let, J.P. Morgan and the others slide under?
Absolutely. Because there's certainly, what happens is that there's another tier of banks right behind them that will step right up to the plate. And what happens is that you get these big money center banks that are trading everything. And then they tell the government, well, if you let us go, then you're not going to sell your bonds. Because a primary dealer, which they are, to be a primary dealer, you buy the bonds and then you resell them. So the Treasury doesn't actually sell the bonds to the average person. The banks are the ones that actually sell the product, and they have to buy it as a primary dealer to get that level of status. They guarantee that they're going to buy so much of the debt. So, that's how they control government. And until we stop the borrowing so that we no longer need the banks, then we'll see reform. But until then, no.
Martin, maybe explain what your economic theories are and how maybe the average person might have a chance of survival in this very difficult financial market if they took a look at some of the theories you had and maybe followed them.
Well, largely there is a business cycle, which government and a lot of academics have been trying to control forever. They say, well, we're going to manage the economy and Keynesianism, and we're supposed to eliminate all recessions and everything would be a perfect flat line, and they've never been able to do it since. And all they do is they constantly aggravate the cycle, and they make each one worse. So unfortunately, we're going to turn down again, probably after around October of 15, and then the next decline for about 4 years into 2020. Percentage-wise, the volatility is going to be much greater than what we saw in 2007 to 2009.
And is that because of quantitative easing?
It gets worse.
Yeah.
No, the quantitative easing, really is beyond all hope at this point in time. It's boxed the Fed in, and the Fed, in theory, what they were doing was that they would buy 30-year bonds to lower the long-term rates. Well, China had them, and they just sold them. And they said, thank you very much, and China reduced its maturity to 5 years or less. So it didn't really help the economy. Then QE3 came, and effectively what they did then was starting to buy mortgage-backed securities, so that really just helped the banks a lot. But they have not really been able to stimulate the economy or to do much of anything. The economy has come back on its own for its own. And the crisis that we had in 2008 and 2009 was largely focused in real estate. So the next time we're going to see probably a much more greater scale of a decline in like pension funds. Each time the economy turns down, it always impacts a different sector. So most of the pension funds, they need at least 8% in order to meet future obligations, and they just can't do it. So you're going to see a lot of capital starting to move into the equity markets, because honestly, that's where you're better off with compared to the banks and what they're paying, and plus a lot of the banks are not necessarily going to be secure. So you're better off going into equities, and this is why the stock market keeps going up and around the same highs and comes back down, goes up, it's going to break out dramatically, and you're going to see a very strong U.S. stock market rally. And what's going to be behind that is mostly the pension funds desperately needing to increase their yields.
And of course, we know how risky it is when you rely on the stock market for your income.
Well, it's been worse for bonds. So it's probably the lesser of the two evils.
Wow. And in the meantime, what is Joe Average supposed to do?
Honestly, I would, be a bit concerned. They're probably going to go after pension funds next. They're putting in, they're entering the SAFE Act, which is just phase one, they're concerned about pension funds, et cetera. But effectively, what really happened with the Syria thing was that they saw that China stood up and said no, and Russia stood up and said no. And that's about 40% of the U.S. national debt. So what they have realized now is that they've lost sovereignty because of the debts. So the way to get rid of that would be basically to seize the pension funds, which are about $17 trillion, and stuff them with all the bonds from China and Russia and other countries, and then they suddenly are in the driver's seat again. They don't need any other foreign country. That's the plan.
And what happens to the pension funds once the government gets their hands on it, considering that the U.S. government has done such a good job of looking after their own finances?
I would kiss it goodbye. I think that in part is why equities are maybe going to do much better. And because the government will just take it and they'll stuff it in government bonds, and they're going to, pay you, virtually nothing for it. So,
is there any way you can have a pension fund and not worry about it?
It's hard really to say that the idea of a pension fund is going to survive, because unless we get to real serious monetary reform, like we had with Bretton Woods back in 1944, where we really have to revise the monetary system, and we got to stop this borrowing and everything else. If we do that, then we have a shot at reconstructing the future. But most people do not realize when, in 1971, when Nixon just closed the gold window, it was temporary, and it was over a trade dispute. Then you had OPEC hit, and then Nixon was getting impeached. So people just got distracted. And at the end of the decade, the government said, oh, well, I don't know, seems to be working. So nobody really has designed the monetary system that we have. Everything is completely out of whack. It's nothing really is real. When money was fixed in value, you didn't have to have somebody at the dock counting the number of Toyotas coming off. If you spent more, it meant you bought more Toyotas. But today, currencies float. So you could spend 20% more for the same amount of cars. So all the trade statistics, all the accounting that government uses, it's all bogus. And we really have to completely revise everything, because we're fighting, shadows that people do not necessarily even have to fight, but politicians don't understand the numbers themselves.
Is this one of the reasons why China has been laying their hands on every piece of gold they can find right now?
I think you have largely people that are, and the same thing in India. You have people that have largely not really trusted their own governments per se, and being freed up to buy some gold, that's largely what they've been doing. In India, they've been some other scams with it where they pretend to be buying gold and they create these banks basically, but at the end of the year, you can decide to take the gold or cash. So a lot of it's not necessarily as people suspect, but it's that gold alone is going to be taking off, etc. But gold is probably going to rise, but I think it's more after you see the next crisis, as it rose largely when the economy turned down. So the economy's been turning up. So it peaked in 11, which was the bottom of our model, and it's been declining ever since. It rose when our model was turning down. So the model will turn down again in 2015, and going into 2020, that's when we should see the next rally in gold coming.
And in the meantime, is it a bad idea to have some or not? Or I guess it's always good to have some gold.
I think you should have some. I think largely I would prefer to have coins rather than bars. And I would be very concerned about keeping them in banks or, honestly, because banks can be, the government says, no, turn over everything. They have to turn over everything. And actually, most people don't realize, but like in the United States, it's actually against the law to put cash in a safety deposit box. You're hiding it from the government. So, and that would apply to gold too.
Right. And what do people have in their safety deposit boxes?
They can actually legally now call it money laundering. Money laundering started actually with laundering money for mafia and for drug guys, but now if you don't pay your taxes, that's money laundering.
Well, they make it sound very vicious, very nasty.
Oh yeah, the definition is completely beside itself at this point. Same thing with terrorism,
That's why they monitor all of our phone calls and emails.
Everything. Absolutely everything. I mean, there's a dispute going on. Merkel, who's the head of Germany, just found out that the NSA was tapping her phone.
Obama called her and said, it's not tapped, but I said, what about the phones of her assistants?
Yeah.
Maybe her private phone isn't tapped. But,
who knows?
Of course, Canada too is involved.
Everything anyhow.
And Canada's involved in a similar thing where Snowden revealed that the Canadian Security Agency was spying on Brazilian mining. And Brazil's president's very upset about that.
Everybody's spying on everybody. That's basically what's going on.
And get used to it. Huh? It's always been that way.
I mean, privacy has become a crime, basically. If you try and hide something, that's money laundering, and we should know everything that you're doing, everything you're thinking about, and that's basically their view.
And that's why they're moving to a cashless society. Where are you putting your money? Again, control of money is power.
Well, just look at it. Honestly, they used to print $10,000 bills in 1934. The highest bill they print today is $100, and quite frankly, I stand in line at Starbucks, and you see the younger kids just hold up their cell phone and they pay with Google Wallet. I think there have been studies now showing that almost a third of the people in the United States have gone for 2 weeks without using physical money.
Well, we'll see how much money we need when we have to buy something. And hopefully, Martin, some of your predictions won't come true. I hope you're hoping the same thing. But again, with the same people in control, doesn't look good.
Well, it's not a question. I mean, will it come true? Absolutely. Because this is the way the system corrects. If nothing happens, then nobody will do anything. So it has to go to the extreme to force change. What is debatable is how far do we go.
Martin, is there a website people could go to maybe check out some of your theories or maybe get help with their own personal finances?
Sure, you can go to armstrongeconomics.com.
Thank you very much for being with us.
Well, it's always a pleasure.
After the break, Tim Wood on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Tim Wood, known as Cycles Man. He's the publisher of the newsletter Cycles News and Views. Welcome to the show, Tim.
Thank you. Thank you for having me.
Well, you're a very much a technical man when it comes to the equity markets, and you love to crunch numbers and tell people what to you is the obvious truth, just looking at the facts of the case, and people keep ignoring you. Well, what are the warning signs that you see right now? And what are people saying? It's not happening. The sky isn't falling, and you're kind of pointing out, yeah, it could, it might, it is.
Jim, thank you. Yes, I use Dow theory and I use cycles work. And cycles is nothing but a way to quantify trend. And then that said, just like the Dow theorists, when you read their material, they worked in basically 3 dimensions: a short, an intermediate, and a long term. I do the same thing with cycles. There's short term quantifications, long term, and then of course your intermediate term. I have been ranked recently, so, people, let me say this up front. People have said, oh, you're a stop clock and, you've been bearish all along and yada, 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 yada. That's true, but that's not true. And let me explain. I said, ever since the rally out of the 2009 low began, which I did call the low a month before to my subscribers, I said, you were moving into a low of a higher degree. I did not think, and I knew it was the 4-year cycle low. I did not think that it would last this long, but I also said that the longer it lasts, the more dangerous it would become, and the meaning there was that more and more people would buy into it and believe it. I also said that it would continue, and I know this sounds like a broken record, until the so-called DNA markers that I have identified that have occurred at all major tops since 1896 are seen once again. Those are statistical based. They are, like I said, it is something that's just, it's an indisputable fact that these things happen at these major tops and at most 4-year cycle tops. And so, yes, from a long-term perspective, I have said this rally is a problem. It's not a rally that's steeped in a fundamental base with a growing economy. It is a rally that is bogus, that is based on Fed-induced trying to fight the deflationary forces of what I think is probably Kondratyov winter. But that said, the price is going up. Market's going up. We have a Dow theory primary trend, bullish trend change in place. It's still there. I haven't seen the DNA markers, and the market's going up. So I haven't stood in front of the freight train, and I still think today, I have no indication that anything has peaked out yet. I'm starting to see some signs, but are we there? Can I say that? No. But that said, it's the big picture that taking a lot of heat over, and people, it's hard for people to understand that with the market at a new high, just this last week the S&P closed a new high, the industrials haven't, and for them to understand how could this possibly be a bad thing that the market has been up so long, and how can you say that things aren't well with the market at the levels that it's at, and how could this be a bear market rally with the prices at new highs? Well, when you look back at history, you find that has happened before. It happened in the period of the 70s, right before the market was cut. I think it was 45, 46, 8%, something like that. Market was at a new high and then down into the next 4-year cycle low. So my point is that yes, short, intermediate term, things are still great. Long term, it's a trap. And so without being, I thought the spirit of this article was without someone having to understand Dow theory, without someone having to be some great technician or without, trying to debate what some fundamental article meant or some fundamental fact or how good the economy really is, I thought, what can I do to present this case to try to make people see that there's a problem? So I took the most fundamental, and those were, that's kind of a contradiction in terms, one of the most basic, I should say, of technical indicators is something called a relative strength indicator. And what it does is it measures the relative strength of the market against itself. In other words, how's it performing today to the way it was performing yesterday? And I took a long-term chart of the Dow Jones Industrial Average. It shows it peaking, at the 2000 top. And you see the divergence with this relative strength indicator as you moved into that 2000 top. It actually peaked in 97, and then you had the divergence at the 98 4-year cycle top, and then we rolled over into the 98 4-year cycle low, and then the market goes up into the 2000 top, and then there's a greater divergence. And that led to the decline into the 2002 low, which, by the way, moved below the 1998 4-year cycle low. And then we go up, up, up and away in the liquidity-driven advance and extended 4-year cycle top into 2007, and relative strength did not confirm.
Are the markets fair? I was just going to ask, does this mean the markets, and I'm kind of trying to visualize this, it's almost you build a roller coaster, and so the higher you get dragged up by the chain, higher and higher and higher, that means when you fall, it's going to be really fast and really deep.
Sort of. That's what's happening here so far. That's the pattern we're seeing, and that's the danger. And what is happening is the market, it's kind of like a wounded animal, if you will. You know, there was a deer killed was hit by a car, and it jumped up and run and then just collapsed. You know, and it's like the point is that it expelled all that energy, but that's all it had. And it's kind of like the market. That's kind of what this is showing us. You know, the market, it's jumping up and running into these 4-year cycle tops, extended tops, and then it just runs out of every ounce of energy. And that's what this relative strength indicator is showing us. It's saying, okay, well, price is at a new high, but, you know, relative strength is not confirming. And then it just collapses down. And so yes, that is the danger here. That's part of what I'm saying, and that's what this indicator is trying to tell us. And now we're at this third or fourth 4-year cycle peak, actually, where the market has moved to an all-time new high, and then as basic as it gets, relative strength is not confirming. And I've attached in the article, a Bloomberg link where people can go and listen to someone else's opinion about relative strength. They can go see for themselves and listen to what the folks on Bloomberg say about the relative strength index. It isn't Tim making this stuff up. It's that I'm trying to pick some very basic indicators and stand back away from the forest so we can see the trees and let people see what is happening here. Because when you're up on it and, close, you can't see, you're muddied by what's happening today, last week, last month, and thinking what's going to happen tomorrow. You can't see the big picture. That's what I'm trying to present. And this relative strength is showing us that there's a problem. And then in the next chart, there's one, something I've been watching for a while now. It's actually pretty amazing that it's held on as well as it has. Looking at the NYSE total issues traded. And, it's just common sense that if you're in a bullish environment in stocks or commodities or whatever it is, you need participation. If you don't have participation, then by default you kind of have distribution. You want people rushing into the market and buying. You want demand, if you will. And that's what this is showing us. The blue line on that chart is showing us from the 90s into the 2000 or 99, 2000 period. You had that. But look at what happened on that chart. When we get into 99, it starts to roll over as we made that. It formed a divergence or a non-confirmation, if you will, with the January 2000 or March 2000 top. Depending on what index you're looking at. I think on the industrials it was in January, and on the S&P it may have been in March of 2000. But anyway, you see that roll over a year-long period where you had that non-confirmation, and that led to the decline into the 4-year cycle low. Well, then look at the next advance out of the 2002 low up into the 2007 4-year cycle top, and see how it also rolled over about a year in advance before the top, but then it didn't move. Price went to a new high, but you didn't have the same participation that you had leading into the 2000 top. So it's kind of the same thing as that relative strength index. You're losing momentum. It's losing the very basis or demand as price moves up into that high. And now look at it. Here we are out of the 2009 low, and this thing has gone nowhere. And it's just kind of like it's just levitating. And, there's just no way to look at that in a positive light other than that, hey, it's still there. Yes, it can go higher, but this is a problem. And when we get the setup that I'm looking for, I'm saying that there is enormous potential to the downside for this stuff to come crashing down once we get that setup, because there's just not the same underlying technical foundation that we had in the true secular bull market period of the 80s and 90s. I mean, you can see it. This is a fact. And then, you go to the third chart, and what I'm showing you there is volume. Look at that. You had the spike And this is, listen, what did I show here? This is advancing volume. Yeah, I didn't remember if I did advancing or total volume. But look at the advancing volume, and this is kind of normal. As price moved up out of the low, out of the 2009 low, people came to the market. They participated. You had advancing volume. And then look what happened. It just kind of fizzled. And it's just completely died on the vine. I mean, the chart kind of speaks for itself. This is just not positive. Yet, price is still holding up. And I think the reason it's holding there, the reason it's levitating, is because the media is telling people that it's okay. And everybody believes that, the liquidity infusion is going to make everything okay. These charts tell us that that's not the case.
And you were just saying the mainstream media tends to maybe gloss over what you feel are very obvious facts that this strong rally in the stock market just is not sustainable.
It's not. And just as I said, the rally out of the 2002 low into the 2007 high, that the liquidity infusion and the thing, manipulation, call it what it is, to try to fight the natural forces of the market would only serve to make matters worse. I feel like that these charts are showing us the same thing here. Yes, price is up. I understand we're at a new high. I'm not disputing that. And like I said, I'm not standing in front of a freight train either. I have not said once since this rally began that, hey, here's the top. I'm saying it's out there. I'm saying I know what it looks like, and I'm saying that once all that stuff is in place, that technical, statistical-based setup occurs. I mean, if I've seen it every time since 1896, then odds are I'm going to see it here. And so once that occurs, then I think this is a train wreck waiting to happen. And the sad thing is that, I said these things back leading into the 2007 advance, and I literally had grown men, I'm not making this up, call me crying, what do I do? What do I do? They were reading my letter, didn't listen to the data, didn't want to believe the data. And I'm like, I don't know what you do. I don't know what you do at this point. And so the point is that people believe what they want to believe. The media, I know for a fact, because I was denied coming on and showing some of this stuff that I had identified back in 2000. I mean, I was told point blank, we can't let you present this data to the public. And I think the disservice is that, the average person, what I don't like to see is the average person screwed. The average person's out there making a living. They're putting their money in their 401k so they can one day hopefully have a retirement. They come home, they turn on TV, and the CNBC and Fox News and everybody else has all the reasons why everything's okay. Well, the other day, Kramer was telling everybody what stocks to buy. And I'm sitting here looking at these charts going, my God, there is an absolute financial disaster waiting to happen. And you turn on the TV and people listen to these stories. I mean, I understand why it's so hard to fathom what I'm saying, but I'm saying, look at the charts, look at the data. And
well, with this information, Tim, what should a person do? What should a sane, rational investor do?
I don't know. I mean, I'm not saying I'm the only one out there with answers. There's got to be somebody else. I don't know who they are, but there's got to be somebody else. I mean, and I know this sounds like a salesman, but one, be careful. I mean, I don't think the stock market at this point is a place to be. But, I do offer, and I don't mean to sound like a salesman. I don't. I'm out here trying to help people here. But if they want the research, if they want to know more, well, one avenue is they can get, I have a letter. If they don't want to pay for that, then, I mean, the other option is just listen to what I'm saying. I'm not saying short the market by no means, but I'm saying this is a disaster waiting to happen. I'm saying you can't believe the mainstream media. I'm saying they didn't tell you about the housing top. They didn't tell you about the 2000 top. They didn't tell you about the top in oil or gold or the top in 2007, and they're not going to tell you about this. And so what frustrates me is, like I said, the common person who is mesmerized and fooled by the mainstream media. And, here I am shouting from the rooftops, and I remember the grown man crying on, what do I do? I'm trying to help. I'm trying to show people, I don't know. I don't know what you do. Listen, do your own homework. Think for yourself. Study. Don't be told what to think. by the mainstream.
Have low interest rates forced people into equities because it appears to be the only thing that makes a decent return?
I think so. I think absolutely that's part of it. And people sit back and, cash is not sexy. Who wants to sit in cash and watch the market go up? I understand the problem. I do. I get it. And someone trying to build a portfolio and they go, well, my God, if I'd have listened to you, I'm not saying not to be there. I've never said that. I've said this advance was going to continue until we get the setup. What I'm saying is that this is not a buy and hold thing, thinking you're going to come out of it on the other side and, once the 4-year cycle does crack, that you're going to come out on the other side unscathed. I'm saying this thing it's dangerous. And these simple charts confirm what I've been saying from the longer-term Dow theory perspective, from the longer-term statistical perspective, from the longer-term whatever, the cyclical phasing within Dow theory, and on and on and on. I took some real simple charts to try to show people simplistically what the more complex, if you will, or more in-depth stuff is really saying.
Well, if low interest rates have forced people to go into the equities market, is this another indication that every time governments seriously interfere with the markets, they just make things worse in the long run?
I absolutely believe that they do make things worse in the long run. In history, I don't say that just to be contrary or anti-government or anything like that. Not at all. I say that based on history. And history shows us that when you go back and look at any time that there has been any sort of manipulation with the market, that it ends up making matters worse. And I said with the rally into the 2007 top, I said, all this is doing is making matters worse. I didn't say that because I had some, great wisdom. I said that because I've studied market history and I knew what the outcome was. I said that because I knew what we were looking at cyclically and from a Dow theory perspective and on and on and on. And I'm saying that here for the same reasons. Yes, it's going to make matters worse because, think about it, the advance is not built on a sound technical base. It's like, building a house on a shifty foundation. It's not sustainable. It's just not sustainable.
Every time we see governments get involved in the markets, they feel it's the right thing. Yet, looking back after the big crash, the most recent one was that governments felt they were doing the right thing by keeping interest rates low and bailing out failing banks. Now we're being told they should have let the banks fail.
I agree. I thought that then. And the thing that's kind of funny to me about government in period is think about this. We elect someone who, and I'm not all, I don't mean to put everybody in the same bucket, but we elect professional politicians. And so by definition, they're politicians. They're not people that are from
industrial backgrounds,
but the real world, okay? And so we elect these suits to go to Washington and fix every problem that we have, from economics to healthcare to whatever other issue you can think of. And I'm thinking that is comical. That's comical to think that because you're an elected official, you automatically know how to fix the stock market. You automatically know how to fix this, or you automatically know how to fix it. And no.
What politicians are very good at is getting reelected.
Exactly. And the best thing they could have done to this market, I know this sounds harsh. There is a study I did going back to 1896. And these are not my words. These are the words of Charles H. Dow and William Peter Hamilton, who followed him, and Robert Ray, who followed Mr. Hamilton in the lineage of Dow theory. They identified bull and bear market periods according to Dow theory. And what I found interesting is that on average, the bear market period lasts about a third the duration of the preceding bull market. Well, if they had left well enough alone at the 2000 top, every indication in 2000 was that, that was a classic top according to Dow theory. It was a classic top. It was just perfect. And yes, we did have a bottom in 2009, but that was not, that's a horse of a whole different color explaining why that was not it. That was not it. But if they had left it alone and let nature take its course and had the purging, 2009 was the low, and we would be coming out of this on a sound technical foundation.
Tim, is there a website people can go to check out some of the ideas you have about the economy and the equity markets?
Well, my website is cyclesman.net, and there are some articles. I do some interviews on there as well. And then, of course, the research is available through the subscription. But yes, there is a website.
Thank you very much for chatting with us, Tim.
Jim, thank you very, very much for having me. And like I said, I hope people will just take heed and think for yourself. Don't be told what to think.
Thanks to our guests, Martin Armstrong and Tim Wood. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.